If you're planning your retirement, one thing's certain: you'll need to take some risk. The question isn't whether you'll take any risk at all, it's what type of risk, how much, and how to do it wisely. Over the decades, advising professionals and successful international families with significant wealth, I've seen the same mistakes again and again and again. Either people misunderstanding risk, trying to avoid risk entirely, or taking too much risk without any real clarity. And that's where a simple framework called C.A.N, capacity, attitude, and need, can help you make really confident, smart decisions. Capacity: how much risk can your finances actually absorb? Attitude: how much volatility can you comfortably live with? Need: how much risk do you actually require to meet your most cherished life goals? And because risk isn't theoretical, I'm going to walk you through 3 real-world examples. A family with $50 million, a family with $2 million, and a family with $10 million. Now, each of these faces risk differently. And by the end of this video, you're going to know how to apply the same thinking to your own wealth. And if you're a high net worth investor, download our free guide below. Inside, you'll find 10 proven principles to help you make the most of market opportunities and reach your financial goals with confidence. So let's start at the top. Someone with $50 million in capital savings from something like the proceeds of a business sale, aiming to withdraw $250,000 per year. Do they have the capacity to take risk? Absolutely. They could weather the very worst market downturns without their lifestyle being affected at all. Do they need to take risk? Well, not really. Their spending is such a tiny fraction of their overall wealth that even cash holdings could fund it just fine. So the key factor here is attitude. Are they comfortable seeing their portfolio go up and down, or could even small swings give them a reason to worry and have sleepless nights? We want to see if they can at least have 2 out of the 3 of these C.A.N attributes in order to start taking any risk at all in retirement. At this type of level of wealth, smart risk isn't about survival at all. It's about opportunity. It's about legacy and how much upside they're willing to chase. Now, let's look at the other end of the spectrum. Somebody with $2 million saved, still planning to withdraw the same $250,000 per year. Now, that's 12.5% of their portfolio annually, which is an extremely high withdrawal rate. Do they have the capacity to take on risk? Well, not really. They can't afford losses in retirement. If the market dropped 20 or 30%, they could run out of money in just a few years' time. So they don't have the capacity, but the paradox here is that they have the need to take risk. Without some growth from investments in the great companies of the world, their money just won't last the rest of their lifetime. And the attitude piece is also critical here. Can they handle the volatility that comes with trying to generate growth? For families in this position, risk is necessary, but it has to be managed very carefully. That might mean things such as sensible budgeting, cutting out some expenses, or even working a little longer to ease the pressure. Finally, let's look at the middle ground. A family with $10 million planning to withdraw the same $250,000 each year. Now that's just 2.5% of their portfolio annually. Do they need to take risk? Well, probably not. They could fund their lifestyle with investments that don't have much volatility at all. But do they have the capacity to take on some risk? Absolutely. They can absorb some of the market swings very easily. So just like the $50 million example, attitude becomes the really critical factor. We know this family has the capacity, they don't have the need, but this family is okay taking on some risk or volatility in retirement so as to benefit from higher expected returns. Now, they don't want to risk their entire family fortress or nest egg. They want some safe and well-protected money, what we call the family war chest. They want some downside protection, but they are willing to take on some market risk. If they're comfortable with some short-term ups and downs, they can take calculated risk to preserve their purchasing power over the long term. Even with the same spending goal, portfolio size and attitude completely change what appropriate risk looks like. When deciding how much risk to take in your retirement, you always need to consider these three things together: capacity, attitude, and need. Two people can spend the same amount annually, but their portfolio, size, and comfort level with market swings will completely change their risk strategy. At the end of the day, risk isn't theoretical. It's about how much of your wealth you're willing to expose to market risk and what you want to achieve. The higher the risk, the higher the return that you should expect to be rewarded for. I've covered exactly what risk means and how to assess it in another video, so check out the link here to dive deeper into this. And if you'd like to see how professional risk management can apply to your own financial life management underlying investment portfolio, you can book a call with our team today. We'll walk you through all of the numbers and help you decide the right flavour and the right level of risk to meet your retirement goals confidently. Simply click the link below.